Welcome back, everyone. This is Major Tom from International Investing LLC. We're going to go over managing portfolio and also managing spreads in your portfolio. This is part 4 of a 4-part series on option spreads, and it is all international investing pretty much does, is just spreads, because they're a high win rate and they make pretty good returns that compound over time. So, managing portfolio and positions. Remember, in this strategy, you're exposed to both extreme upside and downside risk. Okay, so this is just talking about the Iron Condor strategy. All right, so managing portfolio and positions. So we're going to start with portfolio management. Determine what your total portfolio size is before you make a trade. So you're going to open your brokerage app. You're going to take a look at the value of your brokerage app. Are you trading with $1,000? Are you trading with $10,000? Are you trading with $100,000? Are you trading with $1 million? Use no more than 1/10 of your portfolio on any one trade. And as your portfolio gets bigger and bigger and bigger, you're going to have to break these into even more, like, smaller and smaller chunks, because your trade sizing is going to be just too large. Always keep a cash reserve or a liquid stock holding that isn't extremely volatile to protect against margin calls and to play spontaneous gems in the market as they arise. So, what do I mean by this? In order to trade spreads, you're going to basically have to have your brokerage account on margin. And in order to open a spread, you're going to have to basically use margin. So, to avoid being margin called, when, let's say, you open 3 trades and a black swan event happens, you get margin called, and all 3 of your trades are just going terrible, you're having a bad week, and let's say you get margin called. Well, it's important to have cash in your account, or a liquid stock holding like Apple, like SPY, like something that you can easily just trade that's not going to just lose 20-30% of its value overnight. And that way you can have that cash to cover any margin that you need to add to your collateral. And also, as a good rule of thumb as a trader, you should always just have cash just in case there's like a crazy good play that pops up. A good rule of thumb is 10% cash minimum for your total portfolio, and or 10 to 20% of a liquid stock holding. So, if you want to have 10% cash and 10% like Apple, and then sell your Apple when times are tough in order to cover a margin call or something, then buy it back, that's always a good rule of thumb. Also, if you want to just have 20% in Apple and no cash at all, if you feel comfortable doing that, that gives you an opportunity to sell, 10% of your Apple to cover a margin call, or even 5% of your Apple to cover a margin call, or even the whole 20%. So just keep some kind of liquid stock holding or cash in your account if you are selling spreads in order to cover any margin. Now, managing spreads. This is a whole separate segment. Your collateral is how much you are essentially risking on each trade, even though it isn't your max risk. This is the monetary value that will be tied up. So only risk 10% of your portfolio as collateral for any one spread play. Scale your spreads to equate to 10% portfolio weighting. If this means your spread will cost you $200 in collateral to open, and you have a 10% portfolio value to play with of $2,000, then you can open 10 spreads on this play in order to scale into your $2,000 that you need to basically put into a position. So again, cash is trash. If you're trading, and you're a profitable trader, you know that your cash is just trash sitting here losing value over time. We trade in order to make money a lot of times, and if we have $2,000 that we have to allocate into a position, and we're trying to enter a spread that's going to cost $200 in collateral, let's just scale that spread up and get open 10 of them. That'll cover our all $2,000 that we need to play with, and that will also give us a nice 20 to 30% return on our $2,000 of capital, which is going to be really, really good next month when we're trying to roll that into another spread. So judge account value based on total balance. This is a really, really important one, guys and girls. This includes your credits from your spreads as they are within a 70+% win rate. Do not Do not let brokerages fool you into looking at your home screen balance that doesn't include your credit spreads that are actively paying you on the daily. TD Ameritrade and Robinhood are great at doing this and making you spread traders think that your accounts are staying flat until the spreads are closed, which is not true. Every single day you're holding a spread, your spread is gaining value. Even if the stock trades sideways, you're getting 1 to 2% return on investment every single day if you're holding a spread that is less than 30 days till expiration. And my fourth rule for managing spreads is to try to maintain a net neutral or close to neutral positioning for your portfolio to avoid being decimated by overall market moves. And I put an example here. Don't play all bear call spreads or all bull put spreads at the same time. So if I'm opening a bull put spread on like Apple, and I'm opening a bull put spread on Amazon, and I'm opening a bull put spread on Google, and then there's a black swan event and the entire stock market crashes 20-30%, all three of my trades are going to get decimated. You want to try and avoid doing that in your portfolio. Try to balance your overall portfolio as best you can. So if I have two bull put spreads open and I'm trying to open up another trade, I'm going to look for a bear call trade. I'm going to look for an iron condor to maintain neutral. If I have one bear call and I have one bull put in my portfolio, I'm going to try and look for an iron condor play in order to maintain that net neutral in my portfolio as best I can. So how do I close spreads? You can close the spread by letting it expire worthless on expiration, or by closing it manually by buying back the short option and selling off your long option. All right, I'll say that again. You can close the spread manually by buying back the short option and selling off your long option. I can't stress how important this is, because sometimes if you go to close both legs at the same time, you won't get a fill. A lot of times you have to buy back the short option by itself first in order to get better execution on your trade, and then sell off your long option. If you let a losing spread get within 14 days of expiration, you risk getting assigned. So if your spread is a negative on your account and you have a negative P&L on it, and you're within 14 days of expiration on that position, you risk getting assigned. This means if you are short a put, you will get put the shares at the strike you called, 100 shares per contract you are short. This is why it is so important to always close losing spreads before they exceed the credit you aim to make. So this is a perfect risk management strategy that'll keep you from getting assigned and also protect your account from severe downside risk. A lot of these plays, since they have a 75% win rate plus, stand to lose a max loss of 3 times whatever you're going to make as your credit. So in order to avoid getting, maxed out on max losses and getting assigned with a bunch of shares that you don't want, that's going to cause you to get margin called. In order to avoid all those bad things, when a spread starts to go against you, you have to monitor it. When it starts to exceed, like if you were supposed to make a $58 credit on this spread and you're now negative 58 and your max loss is like 150, you want to close that position at negative 58. Just take the loss, move on. You have a 75% win rate. Just take that cash and put it into another spread. It's going to cover the loss, right? Don't stay inside a contract until you hit the max loss. 1, because you risk getting assigned, which is going to make you get margin called. 2, you're sitting in that losing trade for 1 to 3 weeks when you could just be in another winning trade making that money back. Also, 3, if you're at negative 50, you can still stand to lose another $100 until you hit max loss, which is, 2 or 3 times worse. Just get out of the trade. Just get out of it. Cut your losses. Don't be afraid to cut losing trades. It is usually not worth it to let a spread expire worthless on expiration. Oh, this is another thing. This has to do with winning trades. It is usually not worth it to let a spread expire worthless on expiration unless you are within 1 week of expiration and the spread is still below a plus 50% P&L. So let's say I'm currently in an Apple spread and I'm looking at my position. My position in my brokerage app says I'm only a plus 20% P&L, and I've got 1 week till expiration. In which case I'm going to hold it all the way through expiration. I'm going to capture that other 80% P&L and let it expire worthless. If I'm at less than 1 week till expiration and I'm at 50% plus P&L, I'm going to close the short leg of that trade and close the long leg of that trade and just get out of that trade and open a new one. The reasoning behind that is a lot of times it's not worth waiting the 1 to 2 extra weeks in order for that contract to get all the way to 100%. In most cases, it's well worth it to just open a new trade, mostly because we're trading off of the 15-minute charts. The 15-minute charts aren't meant to just last for 30 plus days all the time. The 15-minute charts are good for 1 to 2 weeks usually, and then stocks tend to move in and out of those support and resistance zones and tend to break out. So, you don't want to risk giving back your profits. Also, at less than 1 week till expiration, the spread will significantly lose value every day and get you to 50 to 100% P&L within days. But, in most cases, we close these winning trades at 50% plus in order to open a new trade, capture new Vega decay. That's another thing. The Vega decay is going to be captured in that first week with the time decay. After that first week, Vega has pretty much adjusted. That volatility is adjusted. And you risk losing all of that 50% profit staying in most winning trades till expiration if the stock or the market has a volatile event. So it's best to just, once you get your 50%, just get out. Just take your profit, leave. It's good. Open a new one. You were only in it for a week. You're still going to make your 20-30% for the month. It's just going to take more trades. Managing iron condors is no exception to rule number 3. They should be treated as 2 separate trades on one ticker. As the ticker rises and the short puts become plus 50% P&L, they should be closed. As the short calls become a risk by exceeding the credits to be gained, or they become a plus P&L after or around the same time the puts leg does, you should close it as well and start a new trade and recapture the Vega decay elsewhere. Again, it's very possible in an iron condor to hit both 50% P&L on your put leg and 50% P&L on your call leg at the same time if the stock just trades sideways and the Vega decay takes place. If that happens, you can close both at the same time. That's awesome. But a lot of times it won't happen around the same time. You're going to have to close one leg first, like the put leg, and then hold the call leg until it gets 50%, or close the call leg first and then close the put leg last. You're just going to have to kind of play it out. And sometimes it just keeps pushing up to the upside, and you have to risk manage your upside. A lot of times it'll just keep pushing to the downside. You have to risk manage your downside, even after taking profits on the other side. So iron condors do require a little bit more attention than the normal trades. And that's everything from how to trade spreads, how to look for spreads, how to manage your portfolio when you're trading spreads, and also how to manage your spreads once you're in them, how to close them out, and everything. Also how to analyze your risk portfolios when you get into options, and why selling options is better than going long on options. So hopefully this video series was very, very informative. This is what we use every single month to get 20 to 30% returns. And even though these win rates on selling these options show 75% or so, if you use technical analysis, if you use fundamental analysis together, and you put your short contracts on those support and resistance zones, you're basically going to get up to like a 90 to 95% win rate on these trades, guys and girls. So make sure you're abusing this stuff. Like, this is the stuff that brokers don't want you to know. Like, TD Ameritrade probably hates me because, I'm trading with a hedge fund account. I get business tax benefits, and every single time I'm placing these trades, TD Ameritrade has to give me a credit on my account, and I just become a liability to them. Right? So do this to your brokers. do it to them. Do them dirty. Like if you're in the Robinhood account, you can do it too. If you're in Fidelity, you can do this too. If you're in Schwab, you can do this too. It doesn't matter what broker you use. These strategies are universal. You are going to need level 3 options unlocked on your broker in order to do this stuff. And I do recommend paper trading first if you can. I know paper trading options is difficult. Not all places offer that. But if you can do it, I believe TD Ameritrade allows you to. If you can do it, I would practice on paper first before you do these strategies. However, even if you're not good at these strategies and you're just blindly putting this stuff in, you still have a 75% plus win rate on some of these strategies if you're doing it right. So just check it on Options Strat first, or maybe check it on Options Calculator, which is free to use. Optionscalculator.com, free to use site. Check your strategies on there first. See what your win rate is before you place the trades. Stop taking trades that are below a 50% win rate, below a 60% win rate. Stop doing that crap. Get 70% plus win rate. Get your return on investment of 20% plus in less than 24 days. Make the money, compound the money, and just move on. All right? So that's my advice to everyone out there. Again, I'm not a licensed financial advisor. I just trade big money in a hedge fund, but that's just my words of advice, my words of wisdom. So thanks for tuning in to this long-winded series, and hopefully we're going to do more of these in the future, but this is just series number 1. So thanks for tuning in again. Peace.